Cryptocurrencies like Bitcoin, Ethereum, and countless other tokens have triggered heated debates among investors, economists, and the general public. Despite their purely digital nature and the absence of government backing, these assets have reached astonishing market valuations, at times surging into the trillions of dollars in combined market cap. For some, cryptocurrencies herald a revolution in monetary systems, liberating individuals from reliance on central banks. Others, however, see them as little more than speculative bubbles doomed to burst. Underpinning these discussions is a deep paradox. How can an intangible digital unit created by code and maintained on decentralized networks be assigned any real worth? This question becomes more pressing when we consider the dramatic volatility of crypto prices, skyrocketing one month, plunging the next, and often driven by hype, social media chatter, or regulatory shifts. Yet the story of cryptocurrency runs deeper than mere speculation. Its trajectory offers insights into human psychology, technological innovation, and the evolving nature of trust in financial systems. To better understand this paradox, we should trace how digital currencies emerged. While Bitcoin's 2008 white paper by the pseudonymous Satoshi Nakamoto is often cited as the starting point, efforts to build digital cash go back much further. In the 1980s and 1990s, computer scientists and cryptographers like David Chaum investigated ways to replicate the privacy and simplicity of physical cash on the internet. Their work, often operating under the banner of the cypherpunk movement, explored how cryptographic protocols could allow payments without intermediaries, a concept that pointed toward future cryptocurrencies, even if those early projects tended to rely on centralized entities and ultimately faced legal or technological hurdles. Bitcoin's true innovation was introducing a peer-to-peer ledger or blockchain, which uses cryptographic proof of work and a distributed network of nodes to prevent double spending, all without needing a central authority. In this design, miners compete to solve computational challenges, appending new blocks of transactions to a chain that everyone in the network verifies. The incentive for miners is newly minted Bitcoin plus transaction fees, while the rest of the network benefits from a secure, decentralized system. This architecture spoke to libertarian ideals of individual freedom and skepticism about central banks, especially when Bitcoin debuted in the aftermath of the 2008 financial crisis. By capping Bitcoin's total supply at 21 million coins, Nakamoto reinforced the narrative of digital scarcity, analogous to precious metals. In the ensuing years, adopters championed Bitcoin as digital gold, meant to serve as a hedge against inflation and an alternative to government-issued currency. Initially limited to niche online forums, Bitcoin soon piqued the curiosity of mainstream investors, media outlets, and venture capitalists. As the price soared, and eventually crashed, then soared again, its volatility only drew more attention, both from those anticipating endless gains and from skeptics warning of market mania. In parallel, other cryptocurrencies emerged. Some focused on privacy like Monero, while others, such as Ethereum, introduced smart contracts that allowed programmable transactions and spawned entire ecosystems of decentralized applications. Entrepreneurs, developers, and even corporate giants began exploring blockchain in fields as diverse as supply chain, digital identity, and content distribution. With each expansion, the question persisted: why do these tokens, intangible and often lacking official sanction, command such enormous value? This is where psychological factors and social dynamics enter the picture. Traditional forms of money, be they precious metals, paper bills, or even shells in ancient cultures, have often derived worth primarily through societal consensus and trust. Cryptocurrencies push this idea to new extremes. They exist only as data on a ledger, and yet millions of people worldwide willingly buy, hold, and trade them. As we proceed, we will look more closely at these psychological underpinnings, examine the technology that fuels decentralized trust, and explore how volatility, speculation, and ongoing debates about intrinsic value define the ever-evolving narrative of crypto. Ultimately, these discussions offer deeper lessons about the nature of money, collective belief, and human behavior in hyper-connected markets. Lessons that extend well beyond the realm of cryptocurrency itself. Given that digital tokens have no physical form, their worth hinges on a shared conviction that they serve as viable assets, whether for exchanging value, storing wealth, or enabling new technological ecosystems. Understanding this conviction requires us to examine a mix of psychological, social, and technological factors that contribute to crypto's allure. Humans are social creatures. We often gauge an asset's legitimacy by seeing how widely it is accepted or endorsed by influential figures. When high-profile investors, tech moguls, or celebrities back certain cryptocurrencies, they lend credibility to what might otherwise be perceived as digital curiosities. This dynamic is amplified by social media, where influencers or online communities can trigger buying frenzies through viral posts. The term FOMO, fear of missing out, captures how quickly everyday speculators can jump in, hoping to capitalize on a rising price. Market booms feed on themselves. As prices surge, more onlookers join, further driving up prices, which in turn draws in still more participants. Behavioral economists note that in such bubble phases, optimism and confidence can overshadow rational assessment. Conversely, when sentiment sours, panic selling can spread just as rapidly, leading to dramatic crashes. Bitcoin arrived against the backdrop of the 2008 financial crisis, which eroded trust in banks, regulators, and government monetary policy. By offering a decentralized alternative that no single authority can inflate or freeze, Bitcoin gained traction as a symbol of financial autonomy. Many crypto enthusiasts see themselves as part of a broader movement to wrest control of money away from centralized institutions. This anti-establishment ethos endows cryptocurrencies with a psychological appeal far beyond their technical capabilities. Holding crypto can feel like participating in a freedom-driven project, rather than just investing. Cryptocurrency communities tend to be tight-knit, forming online enclaves that celebrate memes, create shared jargon, and encourage members to HODL, hold, rather than sell. These digital tribes sustain loyalty even through market downturns, sometimes reinforcing the idea that one's chosen coin will inevitably succeed. The drive to uncover the next big thing in technology also plays a role. Just as early internet visionaries recognized massive potential in fledgling online platforms, today's crypto investors may see blockchain networks as the foundation for future financial or organizational models. This innovation bias can inflate valuations sometimes beyond what near-term adoption might justify. The technology that underpins most cryptocurrencies is the blockchain, a data structure that records transactions in chained blocks, each cryptographically linked to the previous one. Participants called miners or validators work to confirm blocks through mechanisms like proof of work or proof of stake, ensuring that no single party can alter the ledger without majority agreement. This setup eliminates a central authority, theoretically making censorship, fraud, or unilateral control difficult. Many see this as a breakthrough in trustless collaboration, since participants do not need to rely on banks or payment processors. This trust model is foundational to crypto's perceived legitimacy. If blockchain can secure transactions autonomously, believers argue, then these digital tokens can function like money or even outdo it. Bitcoin's hard cap of 21 million coins is often likened to precious metals, reinforcing the narrative of digital gold. Meanwhile, other platforms like Ethereum provide utility beyond simple transactions. Smart contracts power decentralized applications like DeFi and NFTs, with transaction fees paid in Ether. The question of intrinsic value is hotly debated. Does a token's supply limit or network usage genuinely create fundamental worth, or does everything boil down to speculative belief? Supporters point to real-world use cases, like cross-border remittances or NFT marketplaces, to claim legitimacy. Critics retort that absent stable cash flows, tangible backing, or official enforcement of value, crypto remains inherently fragile. This tension between practicality and perception helps fuel volatility and ensures that arguments around crypto's true value remain unresolved. Beyond the psychological or community-driven appeal, cryptocurrencies regularly confront the intrinsic value debate. How do we justify their worth beyond consensus and code? Meanwhile, extreme volatility, the hallmark of crypto markets, both captivates investors seeking massive returns and deters those looking for consistent stability. In classical economics, an asset's intrinsic value often ties to factors like dividend yields, industrial use, or redemption promises by governments. Gold, while offering limited industrial benefits, maintains widespread cultural and historical acceptance. By comparison, cryptocurrencies are entirely digital, with no physical utility. Advocates counter that code-based scarcity, global accessibility, and network effects create a form of intangible intrinsic worth. Bitcoin, for instance, can process transactions independently of banks, and Ethereum's smart contracts enable decentralized finance, both arguably delivering real utility. Still, many see crypto speculation as driven primarily by the greater fool dynamic. People buy in, expecting to later sell to someone else at a higher price. When markets turn bearish, liquidity can dry up rapidly, and prices can plummet. Nobel-winning economists have criticized Bitcoin and other tokens as modern iterations of historical manias. Defenders, however, compare crypto to the internet's early days, pointing out that new technology often appears superfluous until breakthroughs spark mass adoption. No discussion of crypto can ignore its spectacular price swings. Bitcoin has repeatedly soared to new highs, tens of thousands of dollars per coin, only to lose half its value within weeks. Smaller altcoins can gain hundreds of percent in days, then crash on a single piece of bad news. This volatility arises from multiple factors. Market maturity: crypto markets are relatively young, with thinner liquidity compared to established stock or commodity exchanges, making them prone to dramatic fluctuations. Leverage and speculative trading. Many traders employ leverage, amplifying both gains and losses. Sudden sentiment shifts can trigger cascading liquidations, further intensifying price moves. Regulatory announcements. A single tweet from a regulator threatening bans or new constraints can spark panic selling. Conversely, announcements of institutional endorsement can ignite surging optimism. Herd instinct. Retail participants often follow online influencers, piling into or fleeing positions en masse. This collective behavior amplifies ups and downs. Such wild volatility raises skepticism about whether crypto can ever function as a stable medium of exchange or a long-term store of value. Proponents argue that volatility should moderate over time as crypto gains broader adoption, improves technology for faster transactions, and attracts deeper institutional liquidity. Critics remain unconvinced, pointing out that repeated boom and bust cycles undermine trust and hamper everyday usability. Even if speculation dominates the short term, certain use cases do provide some grounding. Cross-border remittances can be cheaper via crypto rails, avoiding hefty bank fees. In economically unstable regions, stablecoins pegged to major currencies let individuals preserve wealth more reliably than local fiat. DeFi platforms enable permissionless borrowing and lending, though with significant smart contract risks. Moreover, NFT technology grants verifiable ownership of digital art or in-game items, sparking a wave of creators and collectors. These varied utilities suggest crypto assets hold potential beyond mere gambling. However, whether these applications justify current valuations, or if they will scale to billions of daily users, is still subject to heated debate. Cryptocurrencies rose to fame in part because they lacked central oversight. Yet, as adoption has spread, so have concerns about fraud, environmental costs, and consumer protection. Regulation and mainstream acceptance thus form critical battlegrounds for crypto's future. Governments worldwide have responded unevenly to crypto. Some, like Japan and Switzerland, established licensing regimes that treat exchanges as regulated financial entities. Others, such as China, took harsh stances by banning crypto mining or trading outright. The United States lies between these extremes, with agencies like the SEC and CFTC vying for authority. The result is a patchwork of rules that frustrates businesses seeking clarity and pushes some innovation offshore. Institutional investors, meanwhile, have dipped their toes in the crypto pool. Major banks now offer custody or trading services, and corporations have held Bitcoin on balance sheets as a hedge. This institutional influx fosters legitimacy, but also demands robust compliance with anti-money laundering, AML, and Know Your Customer, KYC, rules. Many early crypto devotees lament that such regulations dilute the ethos of decentralization, even as they grant the market a veneer of mainstream credibility. Although the underlying blockchains for Bitcoin or Ethereum are notoriously hard to hack at the protocol level, exchanges and custodial wallets remain prime targets. Over the years, billions of dollars in cryptocurrency have been stolen in high-profile hacks, fueling doubts about the asset class. Phishing attacks, Ponzi schemes, and manipulated pump-and-dump schemes also tarnish crypto's image. Regulators keen on protecting consumers see these vulnerabilities as justification for stricter oversight. Another point of contention is energy consumption. Bitcoin's proof-of-work mechanism requires vast computational resources, leading critics to decry the environmental impact. Proponents note that a growing share of mining uses renewable energy, and alternative consensus models like proof-of-stake significantly reduce carbon footprints. Nonetheless, negative publicity about energy use continues to shape public perception. Governments themselves are exploring digital alternatives through central bank digital currencies, or CBDCs. China has pioneered the digital yuan, and other major economies, including the United States and the European Union, are studying similar concepts. CBDCs could modernize payment systems and bolster financial inclusion, but they also challenge the fundamental crypto premise of decentralization. A state-backed digital currency, by definition, centralizes power in a central bank. Its adoption might overshadow private cryptocurrencies, or it might coexist with them, fulfilling different roles. Uncertainty about CBDC rollouts adds further twists to crypto's regulatory outlook. Despite ongoing hurdles, crypto's real-world use cases are expanding. In certain emerging markets, sending money via crypto is cheaper and faster than traditional remittances. People fleeing economic turmoil may also rely on Bitcoin or stablecoins as a safeguard. Platforms on Ethereum and other networks allow lending, borrowing, and interest earning without conventional banks. Although innovative, DeFi can be prone to hacks, market manipulation, and complex user interfaces. Non-fungible tokens, or NFTs, have brought digital ownership of art, music, and virtual collectibles to the mainstream. While some see them as speculative, they also unlock new revenue streams for creators and could reshape how we view digital property rights. Beyond public cryptocurrencies, many corporations explore private or enterprise blockchain solutions to streamline supply chains or automate complex workflows. This focus on distributed ledgers suggests that even if certain crypto tokens fade, the underlying blockchain concept may endure. The jury is still out on how widely or deeply crypto will integrate into daily life. Critics argue that these applications remain niche, partially due to volatility, security gaps, and complex onboarding. Optimists contend that the internet's early days looked similarly sparse, yet eventually became ubiquitous. If blockchain-based services prove cost-effective, user-friendly, and resilient, they might reshape finance, commerce, or digital ownership models on a massive scale. Cryptocurrencies embody an evident contradiction. Digital tokens born from cryptographic code can achieve massive valuations fueled by psychological conviction, decentralized technology, and social momentum. Their price volatility, swinging from euphoric highs to devastating lows, underscores the fragility of that conviction. Some see this as proof that crypto is a bubble, a scheme dependent on finding greater fools. Others argue it's the natural progression of a disruptive technology still in its adolescence. Beneath these conflicting views lies a broader exploration of trust and value. All forms of money, be it gold or government fiat, hinge on collective belief and acceptance. Cryptocurrencies magnify this reality by removing physical form or state backing, placing the entire framework of trust in the hands of decentralized networks and social consensus. This unique blend of ideology, technological promise, and fervent community support both empowers crypto and makes it precariously dependent on sentiment. Going forward, regulatory clarity will likely shape the evolution of crypto. While heavy restrictions may dampen innovation, sensible frameworks could encourage mainstream adoption and reduce scams. Meanwhile, the push for greener, more efficient consensus mechanisms might alleviate environmental concerns. Central bank digital currencies may either compete with or complement decentralized cryptocurrencies, reshuffling the global financial landscape further. In parallel, continued development of second-layer solutions, smart contract ecosystems, and cross-chain interoperability may transform the user experience, potentially bringing millions more into the crypto fold. What remains indisputable is that the paradox of cryptocurrency's value has opened new debates on the nature of money, property rights, and the power of decentralized technologies. Whether crypto fulfills its grand visions, becoming digital gold, powering a new financial infrastructure, or simply offering more efficient cross-border payments, depends on how these debates resolve and how well the technology meets real-world needs. For now, we stand at a frontier. If cryptocurrencies evolve into stable, widely accepted financial instruments, their intangible origins will exemplify how far collective belief can shape value. If they falter under market hysteria or regulatory crackdowns, they may be remembered as a cautionary tale of speculative mania. Either outcome or something in between will continue to fascinate economists, technologists, and ordinary individuals who see in crypto an emblem of both innovation and risk.